I'm looking at my screens right now and I'm seeing something I haven't seen in 12 years of tracking physical metals markets. Gold, silver, and copper are all ripping higher at the exact same time, in perfect synchronization. And the mainstream financial networks, they're calling it seasonal rebalancing. They're telling you this is a technical glitch in bond pricing. They're explaining away the commodity moves as temporary spikes. Let me tell you what's actually happening. This isn't a rally. This is a bank run on the physical world. I'm a private commodities analyst. I've been stacking physical silver and tracking vault inventories for over a decade. I built this channel because I got tired of waiting 12 hours for Bloomberg to report what I could see happening in real time on the primary data feeds. And frankly, I got sick of watching all these AI-generated channels pump out fake hype about silver while actual retail stackers are trying to figure out what's real. So I'm using this avatar for one reason: speed. I can get you the data and the analysis faster than anyone else, and it's coming from someone who actually has skin in the game. Here's what I saw this morning. Gold cleared $4,400. Silver is probing the $80 wall with a vertical parabolic move. Copper is testing $6. And here's the kicker. They're all moving together, not just correlated. I'm talking about a correlation 1 event. When you see all three of these metals exploding at the exact same second, you're not watching a normal market. You're watching a system failure. But why? Why are the three biggest pillars of the physical commodity world all breaking out simultaneously? The answer isn't what you think. It's not just inflation. It's not just geopolitical tension. The real answer lies in a model that most investors think is the safest, most boring strategy on earth. And that model just snapped. Let me lay out exactly what I'm going to show you. The risk-parity model, the trillion-dollar engine that's supposed to balance stocks and bonds to create steady returns, has reached a mathematical dead end. And the reason is something called fiscal dominance. Because of this phenomenon, bonds have turned into what I call return-free risk. They're no longer the safe haven they're supposed to be. And that's forcing a violent, panicked migration into hard assets. But it's not just about inflation or monetary policy. There's a structural component here that nobody's talking about. We're looking at an inventory squeeze meeting a gamma squeeze in the metals complex. And when I show you the math on copper inventories specifically, you're going to understand why this isn't just another bull run. This is different. I'm going to break down the mechanism of fiscal dominance in terms anyone can understand. I'm going to run the actual numbers on copper inventories. And when I tell you we're down to 1.8 days of global supply, I want you to understand what that means for price discovery. And then I'm going to walk you through my exact personal battle plan for navigating this snap. What I'm watching, what my conditional triggers are, and where I'm positioning. But first, we need to understand the fire that's currently melting the basement of the global financial system. Let me give you the on-the-ground reality. A few hours ago, around mid-morning Eastern time, I pulled up the metals complex on my terminal. Here's what I saw. Gold, $4,450.08, up 2.72%. We have officially cleared the $4,400 battle zone. That's a level that's been tested multiple times over the past few weeks, and we just blew through it. Silver, $76.84, up 5.51%. This is a vertical move. When silver moves like this, it's not creeping higher, it's being panic bid. We're approaching the $80 wall, which is a massive psychological resistance level. Copper, $5.95.9 per pound. We're probing $6, which I call terminal resistance. If copper breaks and holds above $6, we're not talking about a rally anymore. We're talking about a regime shift. And here's one that most people aren't watching closely enough. Platinum, $2,283.51, up 6.83%. Platinum is the ultimate catch-up trade, and it's finally waking up. Now here's what you need to understand about paper versus physical. The prices you're seeing on the COMEX, the paper prices, are skyrocketing. But when you look at the actual physical inventories in the LME and COMEX vaults, you're seeing something terrifying. The vaults are being drained. Let me give you a fact that should make your hair stand up. Global copper inventories are currently at 1.8 days of global consumption. Read that again. 1.8 days. If a single major manufacturer, let's say a global EV company, decides they want to take physical delivery of copper to secure their supply chain, there is not enough copper sitting in the vaults to satisfy that order without completely destroying the price discovery mechanism. Stop. I want you to really look at what's happening with silver specifically. Pull up a chart if you're following along. Look at that verticality. Look at how silver is moving relative to gold. This is not a slow, steady climb. This is not a healthy consolidation. This is a panic bid. This is what happens when market participants realize that the paper promises might not be backed by physical metal. And here's something that's making this entire situation worse. Tariffs. The United States recently imposed a 50% import duty on refined copper. Think about what that means. We already have a global shortage, 1.8 days of inventory. And now the US has essentially cut itself off from global supply by making it economically unviable to import refined copper. We've turned a global shortage into a domestic North American crisis. The prices are screaming, but the mechanism that's making them scream is a trap that's been set for years. And to understand that trap, we need to talk about fiscal dominance. Let me teach you a concept that's going to change how you see the entire financial system. It's called fiscal dominance. And once you understand it, you'll see why the risk-parity model is fundamentally broken. Here's the simple definition. Fiscal dominance occurs when a government's debt load is so massive that the central bank is no longer independent. The central bank can't raise interest rates to fight inflation because doing so would immediately bankrupt the government through interest payments on that debt. Let me walk you through the mechanism. In a normal market environment, when stocks go down, bonds typically go up. That's the whole premise of the 60-40 portfolio and the risk-parity model. You're supposed to be balanced. When one asset class tanks, the other cushions the blow. But in a fiscal dominance environment, both stocks and bonds become toxic. Why? Because the central bank is trapped. They can't raise rates to cool down inflation without destroying the government's balance sheet. But they also can't keep rates low without letting inflation run wild, which destroys the real value of bonds. Here's an analogy that might help. Think of the Federal Reserve as a thermostat. Its job is to keep the economic temperature comfortable. When things get too hot, when inflation rises, the thermostat is supposed to kick on the air conditioning by raising interest rates. When things get too cold, when we're in a recession, it is supposed to turn on the heat by lowering rates. But now imagine that someone has placed a blowtorch directly on the thermostat. That blowtorch is the US Treasury and its massive debt load. No matter how hot the room gets, the thermostat is physically stuck. It can't turn on the AC because the blowtorch, the threat of government insolvency, is holding it in place. This is why gold and copper are ripping right now. Institutional investors are looking at this situation and realizing the thermostat is broken. The Federal Reserve cannot do its job. And when investors lose faith in the central bank's ability to manage the economy, they flee into hard assets. They flee into things that can't be printed, that can't be debased, that have physical scarcity. This is also why the risk-parity model is snapping. If you're a fund manager running a risk-parity strategy, your entire premise is that bonds will be there to cushion the blow when stocks fall. But what happens when bonds are falling at the same time? What happens when both legs of your strategy are simultaneously toxic? You're forced to reallocate. And where do you go? You can't go to cash because inflation is eating it alive. You can't stay in bonds because they're being liquidated. So you go to gold, you go to silver, you go to copper, you go to any hard asset that can preserve purchasing power. Once you see the blowtorch, the math starts to look terrifying. Let me run some numbers for you. Let's start with copper. We've established that the LME has approximately 1.8 days of global copper supply in its vaults. Now let's stress test this. Imagine a scenario where just one major manufacturer decides they need to secure physical copper. Let's say they need 10,000 tons for their manufacturing operations over the next quarter. In a normal market with healthy inventory levels, that's not a problem. The LME facilitates the transaction, the warehouse releases the metal, and life goes on. But we're not in a normal market. With only 1.8 days of inventory, a 10,000-ton order represents a significant chunk of available supply. And here's where it gets dangerous. Once that order hits the market, everyone else sees the inventory drawdown. Other manufacturers start thinking, if they're securing physical, maybe I should too. You get a cascade effect. And when you're down to 1.8 days of inventory, the price doesn't just go to $6. It goes to no offer, meaning there's literally no copper available at any price because the physical metal doesn't exist. Now let's look at silver. I want to show you a calculation that should make you pause. The current silver to gold ratio is sitting around 58 to 1. Historically, that ratio has moved as low as 50 to 1 during major bull runs in precious metals. If gold is trading at $4,450 and the silver to gold ratio compresses to 50 to 1, that puts silver at $89 per ounce. We're currently at $76.84. That means there's a $12 vacuum above us. $12 of price appreciation that would simply be silver catching up to gold on a historical ratio basis. But here's what makes this different from past bull runs. Let me give you a comparison that illustrates the scale of the problem. The global bond market is worth somewhere around $130 trillion. The global silver market, the physical silver available for investment, is worth maybe $30 billion. Think about that ratio. You have a $130 trillion market that's currently being liquidated because of fiscal dominance. And you have a $30 billion market that investors are trying to flee into. It's like a 10-lane highway trying to merge into a single-person doorway. Even if just 1% of bond market capital tries to rotate into physical silver, that's $1.3 trillion chasing $30 billion worth of metal. The math doesn't work. The price has to go vertical to clear the market. Let me recap where we are so far, because this is important. The risk-parity model, the strategy that manages trillions of dollars, is snapping under the weight of fiscal dominance. The Federal Reserve is trapped and cannot raise rates without bankrupting the government. Bonds have become toxic, and we're down to 1.8 days of copper inventory while facing a 50% tariff on imports. And yet, if you talk to your financial advisor right now, they're probably still telling you to keep 40% of your wealth in bonds. They're telling you bonds are safe. They're telling you this is all temporary volatility. So why is every mainstream advisor still clinging to a model that's being liquidated in real time? Now, I know some of you are thinking, this sounds like a blow off top. This sounds like irrational exuberance. And I want to steelman that argument because it's important to address the skeptics. The skeptics are pointing to the flash crash that happened on December 30th. They're saying that was the warning sign. They're arguing that today's move is just a dead cat bounce driven by low liquidity during the New Year period. They're telling you to sell into this strength because it's all going to come crashing down. Let me tell you why I think that argument is wrong. A dead cat doesn't bounce on 1.8 days of inventory. This isn't a liquidity vacuum driven by holiday trading volumes. This is a physical shortage meeting a structural tariff shock meeting a sovereign debt crisis. The blow-off-top narrative assumes that this is purely speculative momentum. It assumes there's no fundamental driver behind the move. But the skeptics are ignoring the inventory data. They're ignoring the tariffs. They're ignoring the fiscal dominance math. Here's another myth I want to destroy. A lot of traditional analysts will tell you that higher interest rates are bad for gold. The logic is that when rates go up, the opportunity cost of holding gold increases because gold doesn't pay a yield. So investors should sell gold and buy bonds instead. But that logic only works in a normal interest rate environment. In a fiscal dominance environment, higher rates don't make bonds more attractive. Higher rates confirm the government's insolvency. When the 10-year Treasury yield spikes, it's not because the economy is strong, it's because bond investors are demanding a higher risk premium to hold government debt. And when investors lose faith in government debt, they don't rotate into other paper assets. They rotate into gold. So higher rates in a fiscal dominance scenario aren't bearish for gold, they're rocket fuel. Now, even if the skeptics are right about a temporary pullback, even if we get a 10 or 15% correction in the next few weeks, the institutional money is already moving toward the exits. The smart money isn't waiting to see if bonds recover. They're repositioning now. So what happens next? Let me walk you through the likely institutional response and the indicators I'm watching. First, watch the CME. The Chicago Mercantile Exchange is going to try to break this fever by hiking margin requirements. When you see parabolic moves in commodities, the exchange's first instinct is to make it too expensive to hold long positions. They'll increase the amount of capital you need to maintain a futures position, forcing leveraged traders to either put up more money or liquidate. This is a standard playbook. They did it during the silver squeeze in 2011. They did it during the oil spike in 2022. And they'll do it again. So if you see a sudden margin hike announced, expect short-term volatility as leveraged positions get flushed out. Second, keep your ears open for force majeure rumors. I'm already hearing unverified whispers, and I want to stress that these are unverified, of certain silver dealers declaring force majeure. That's a legal term that means they can't fulfill their contractual obligations due to circumstances beyond their control. In this case, it would mean they can't deliver the physical silver they promised because they can't source it. If those rumors turn out to be true, that's a massive red flag. It means the paper-to-physical disconnect is even worse than the official numbers suggest. Third, there are reports of major funds dumping bonds to cover commodity margin calls. This is the flip side of the margin hike scenario. When the CME raises margins, funds that are long commodities need to come up with cash fast. And the easiest place to get that cash is to sell bonds, which, of course, puts more downward pressure on bond prices, which reinforces the fiscal dominance spiral. Here are the specific indicators I'm watching. The $6 level on copper is critical. If copper breaks and holds above $6 for more than 2 trading sessions, we're in a new regime. That's not a technical level. That's a psychological and structural level that signals physical scarcity has overwhelmed the paper market. The silver to gold ratio is the other key metric. If that ratio drops below 55 to 1, we're in acceleration mode. And if it drops below 50 to 1, we're in full panic. And here's a pattern interrupt I want you to pay attention to. Stop what you're doing and look at the DXY, the US dollar index. Normally, when Treasury yields rise, the dollar strengthens because foreign investors need to buy dollars to purchase US bonds. But if you see a scenario where yields are rising and the dollar is falling, that's the correlation 1 snap completing itself. That means foreign investors are liquidating US bonds entirely, not just rotating within the dollar-denominated asset space. If that happens, the game is over. The system is in full reset mode. The system is trying to reset the rules in real time. And here's how I'm personally reacting to the chaos. Let me walk you through my personal battle plan. I want to be very clear. This is not financial advice. This is what I am doing with my own capital based on my own risk tolerance and my own 12 years of experience in this market. Your situation is different from mine, and you need to make your own decisions. Here's what I'm watching. The daily candle close on copper is my primary indicator. $6 is the line between a rally and a regime shift. If copper closes above $6 today and then holds above $5.90 through the London close tomorrow, I'm maintaining my current metals exposure. I'm not adding, but I'm not selling either. However, I am tightening my stop losses. I've already locked in gains on about 5% of my silver position from the move earlier this week. The rest of my physical holdings don't have stop losses because you can't stop loss physical metal, but my paper positions, the futures, and ETF exposure I use for tactical trading, those have stops. Here's my first conditional action. If copper holds above $5.90 through the London close, I'm keeping my exposure but moving my stops up to protect recent gains. I'm not giving back more than 3% on any position from here. The volatility is too high, and the risk of a CME margin hike is too real. Second conditional action. If gold's $4,400 level gets retested and fails to hold, meaning we break back below 4,400 and CANT reclaim it within 24 hours, I'm moving 25% of my physical holdings into cash. Not selling the core, never selling the core, but I would rotate some of the tactical position into cash and wait for the volatility to settle before redeploying. Why 25%? Because I've learned over 12 years that you never sell everything at once. You scale in and you scale out. If I'm wrong and the move continues higher, I still have 75% exposure. If I'm right and we get a pullback, I have dry powder to redeploy at better prices. Third conditional action, and this is important. If silver hits the $80 wall today, I am sitting on my hands. I don't care how much FOMO I feel. I don't care how many people are screaming on social media that silver is going to $100. I do not chase vertical moves into psychological resistance. $80 is a massive psychological level. It's a round number. It's going to attract profit taking. And if I'm not already in the position before it hits 80, I'm waiting for the pullback. I've been burned too many times trying to chase parabolic moves. The risk reward at $80 is terrible. Here's what I'm not doing. I'm not selling my physical silver stack. I don't care what happens in the short term. Physical silver is my insurance policy against the exact scenario we're watching unfold right now. I'm not selling my gold. And I'm not rotating back into bonds, no matter how attractive the yields look. The plan is set, but the window to execute is narrowing by the hour. These markets are moving so fast that by the time you hear about a move on the mainstream news, it's already over. That's why I built this channel. That's why I'm using this AI avatar to get the information out as fast as possible. Let me bring this all together. The risk-parity model has snapped under the weight of fiscal dominance. Bonds are no longer the safe haven they're supposed to be because the Federal Reserve is trapped by the government's massive debt load. We're facing a physical inventory crisis in copper, 1.8 days of global supply, and a monetary flight into gold and silver. 1.8 days of supply is all that stands between us and a total price reset in the copper market. The screen may tell you things are normal, the financial networks may tell you this is just seasonal volatility, but the vault is empty. The physical metal is being drained, and the smart money is repositioning into hard assets while the window is still open. Pay attention to the physical reality, not the paper promises. I want you to understand that what we're watching right now is not just another bull market in commodities. This is a structural break in the financial system. The models that have governed asset allocation for decades are failing in real time. The assumptions that underpin modern portfolio theory, that stocks and bonds are negatively correlated, that diversification reduces risk, that central banks can manage the business cycle, all of those assumptions are being tested, and they're failing. The reason I'm sharing this with you, the reason I built this channel, is because I remember what it was like to be a retail investor without access to primary data. I remember refreshing Bloomberg's website every 10 minutes, waiting for them to report something I could already see happening on the terminal. I remember the frustration of being 12 hours behind the institutional money. You don't have to be behind anymore. You have access to the same information I do. You can see the inventory data. You can see the price action. You can see the fiscal dominance trap closing. The question is, what are you going to do about it? I've given you my plan. I've shown you the levels I'm watching. I've explained the mechanism that's driving this move. Now it's up to you to make your own decisions based on your own situation. But do me a favor. Don't just take my word for it. Don't just take anyone's word for it. Look at the data yourself. Pull up the LME inventory reports. Look at the copper price chart. Look at the silver to gold ratio. Look at treasury yields versus the dollar index. The data is screaming. The only question is whether you're listening. If you want to go deeper on the copper tariff shock, why the 50% import duty is creating an isolated price island in North America, and what that means for industrial consumers over the next 6 months, I'll be breaking that down in my next deep dive. That's a whole separate structural problem that's layering on top of everything else we've discussed. But for now, I want you to focus on the immediate situation. Gold above 4,400, silver approaching 80, copper probing $6. These are not just price levels. These are stress tests of the global financial system. And right now, the system is failing the test. The next 72 hours are going to be critical. And we're going into the Asian trading session overnight. And that's when a lot of the physical buying happens. If we see follow-through in Hong Kong and Shanghai, if we see the Chinese physical market confirm this move, then this isn't a Western liquidity event. This is global. Watch the $6 level on copper. Watch the $80 level on silver. Watch the DXY against rising yields. Those three indicators will tell you everything you need to know about whether this is a temporary squeeze or a permanent regime shift. I've been doing this for 12 years. I've seen blow-off tops. I've seen false breakouts. I've seen margin-induced liquidations. And I've also seen the real thing. I've seen what happens when physical scarcity meets paper promises. This feels like the real thing, not because the charts look pretty, not because I want it to be true, but because the math doesn't work anymore. The inventory doesn't exist. The central bank is trapped. The bonds are being liquidated. And the physical metal is being accumulated by people who understand what's coming. You can't print copper. You can't print silver, you can't print gold. And when the paper system realizes it's been writing checks the physical market can't cash, the repricing is violent, that's what we're watching right now. So stay sharp. Keep your stops tight if you're trading. Keep your core position intact if you're stacking. And whatever you do, don't let the mainstream narrative lull you back to sleep. The alarm is ringing, the vault is empty, and the system is failing in real time. This is not a drill.